Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Small, smart steps today can lead to big growth tomorrow. Stay tuned for part 2. Want to build lasting wealth and secure your future? Investing isn't just for financial experts, it's a powerful tool everyone can use. It helps your money grow, working harder for you over time to reach your financial goals. This guide will walk you through the basics of investing as a beginner. We'll cover everything from understanding common investment options to getting started with your first investments. You'll learn simple strategies to make smart choices and build a solid financial foundation. Why invest? Understanding the benefits and risks. Investing might seem complex, but it's a key step toward building wealth. It helps your money work for you, potentially growing more than it would just sitting unused. Let's explore why investing matters and what to consider. The power of compounding and long-term growth. Imagine a snowball rolling downhill. It starts small, but as it goes, it picks up more snow, getting bigger and bigger. This is like compounding, often called the eighth wonder of the world. When you invest, your money earns returns. Then, those returns also start earning returns themselves. This effect builds over time. For example, if you invest $1,000 and earn 10% interest, you get $100 the first year. Now you have $1,100. The next year, you earn 10% on that $1,100, which is $110. Your earnings are now also earning money. Over many years, this small start turns into significant growth. The longer your money stays invested, the more powerful compounding becomes. Inflation, the hidden cost of not investing. Have you noticed how prices often go up over time? The cost of groceries, gas, and housing tends to increase each year. This is called inflation. Inflation means your money buys less in the future than it does today. If you just keep your money in a savings account earning very little interest, inflation can slowly reduce its value. Investing helps fight inflation. By putting your money into assets that can grow faster than the rate of inflation, you protect your purchasing power. This helps ensure your money will still be valuable years down the road when you need it most. Navigating investment risks, volatility, and loss. While investing offers great potential, it's also important to understand the risks. Every investment carries some level of risk. Your investments can go down in value. Here are some common risks you might encounter. Market volatility. The value of investments can fluctuate short-term. Stock prices, for example, can rise and fall daily. This up and down movement is normal. Inflation risk. Even though investing helps combat inflation, some investments might not keep pace with rising costs. This means your returns could still be lower than inflation. Interest rate risk. Changes in interest rates can affect the value of certain investments, especially bonds. When interest rates rise, bond prices often fall. Understanding these risks doesn't mean you should avoid investing. Instead, it means you should diversify your investments and understand your comfort level with risk. It also highlights the importance of a long-term perspective. Short-term ups and downs often smooth out over many years. Setting your financial foundation before you invest. Before you put your hard-earned money into investments, it's smart to build a strong financial base. Think of it like building a house. You wouldn't start framing the walls before laying a solid foundation. These steps ensure your money grows without unexpected setbacks. Laying this groundwork helps you invest confidently and avoid common beginner mistakes. Building an emergency fund, your financial safety net. Life is full of surprises. What if your car breaks down, or you face an unexpected medical bill? An emergency fund is your financial cushion for these moments. It's crucial to have readily available cash, usually 3 to 6 months' worth of living expenses saved in an easily accessible account, like a high-yield savings account. Why is this so important before you invest? If an emergency pops up and you don't have this fund, You might be forced to sell your investments at a bad time, even at a loss. This defeats the purpose of long-term growth. An emergency fund keeps your investments safe from life's curveballs. Understanding and eliminating high-interest debt. Before you think about investing, let's talk about debt. Specifically, high-interest debt like credit card balances or personal loans. The interest rates on these can be incredibly high, sometimes 15% or even 25%. Compare that to the typical historical returns of the stock market, which average around 7–10% annually. Paying off high-interest debt is often a better return than investing. If your credit card charges 20% interest, paying it off is like getting a guaranteed 20% return on your money. It reduces your financial burden and frees up more cash flow for future investing. Prioritize clearing these debts. Defining your investment goals and timeline. What do you want your money to do for you? This is a key question before you start investing. Your investment goals guide your strategy. Are you saving for retirement decades away? A down payment on a home in 5 years? Or perhaps a child's college education? Each goal has a different timeline. Long-term goals. For goals like retirement, you can often take on more risk with investments like stocks, which have higher potential for growth over time. Medium-term goals. For a house down payment, you might choose a more balanced approach, combining stocks with less volatile options. Short-term goals. Money needed soon should generally stay in very safe places, like high-yield savings accounts, where its value won't fluctuate. Clearly defining your goals and timeline helps you choose the right investments for your unique situation. Choosing your investment approach, passive versus active. When you start investing, you'll hear about two main paths, passive and active investing. Each has a different philosophy, and understanding them helps you pick what's right for your comfort level and goals as a beginner. Let's look at how they work and which might be a better fit for you. Passive investing, the buy and hold strategy. Passive investing is all about keeping things simple and playing the long game. It's often called a buy and hold strategy because you buy investments and hold onto them for many years, aiming for long-term growth. This approach trusts that the overall market will go up over time. You aren't trying to beat the market. Instead, you're trying to match its performance. One of the big benefits here is diversification. You invest in a broad range of assets, which spreads out your risk. This means if one company or industry struggles, your entire portfolio isn't hit hard. Passive investing involves minimal active management once you set up your investments. You typically don't need to do constant research or make frequent trades. This makes it ideal for true beginners. The most common ways to do passive investing are through index funds and ETFs. An index fund holds a collection of stocks or bonds that mirror a specific market index, like the S&P 500. When you invest in an S&P 500 index fund, you essentially own a tiny piece of 500 of the largest U.S. companies. ETFs are similar to index funds but trade like individual stocks on an exchange throughout the day. They also track an index or a specific sector. Both index funds and ETFs offer instant diversification and lower fees compared to actively managed funds. This strategy lets your money grow steadily over decades. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.